Hi, nice to have you with us once again. We're going to be talking about carbon tax. Now, it's two words that a lot of people suddenly go, ooh, at. And we'll try and work through some of the myths and find out more information about it, because the more information we have at hand, the better it is for all of us. Joining me in the studio, Mansoor Parker, who's the tax executive at Edward Nathan Sonnenbergs, and a senior associate at ENS, Andrew Gilder. Guys, thank you for your time. Andrew, just to start with you, because you're more the environmental side of it, the legislative side. Just reading generally about carbon tax and how it's been implemented around the world and looking at the different models, people seem to be very confused about it. I mean, Sweden taxes at the consumer end, Quebec taxes at the middleman end. I think there's no uniform model that we can look at and adopt here.
So the design of the tax really has to be kind of intuitive, or it be intuited from the economy. So if you're looking at Quebec, there will be a number of circumstances that have informed that design. Similarly, in Sweden and elsewhere, I mean, we have now a carbon tax in operation in Australia. And in South Africa, the biggest focus of the carbon tax would be around the fossil fuel input to manufacturing, whether that be manufacturing of goods or power. So the design depends on what the economy looks like.
So is that what the South Africans are looking at, is reducing that fossil fuel footprint in South Africa specifically?
Correct. So what is proposed is not, for example, to measure emissions at the stack and to say, this is the volume of greenhouse gas that you've emitted and now we're going to tax you. On the contrary, what's going to happen is that it's a calculation based on the fuel that is used, the calorific value of that fuel, and corrected for using an intensity factor, an emissions intensity factor that is specific to a particular sector.
And there were two options at that to consider.
Yeah.
One was to look at the actual greenhouse gas emissions from a particular facility, such as a factory. But that would require very expensive equipment to be installed to measure those emissions. Yeah. The easier way is a sort of a proxy system to look at the fossil fuels coming in and to work out the carbon content of those fossil fuels and then to calculate the carbon tax. So that was a consideration taken into account in developing the scheme. But because the one was fairly administratively burdensome to implement, the former option has been chosen by looking at fossil fuels coming in. And I would agree that the intent behind this is to look at changing, on the one hand, the mix of fossil fuels between coal, gas, oil, as well as to change over from fossil fuels to renewable energy sources, such as solar and wind.
Okay, so Mansoor, how would you see it being administered? Would I have to, as a factory owner, submit my buying schedule of product that I'm using to fuel my factory, which would then be assessed and I would be taxed on that?
That's one of the issues that Andrew and I have been going through, because Treasury and SARS would not be good at measuring emissions. That's something that falls better under the Department of Environmental Affairs, where there is currently a reporting obligation being put in place. So one of the issues that we would have to look at is how would your reporting obligation to one government department determine your payment of tax to another government department, and what would the interaction be between those two?
I just see problems coming.
Well, as well. I mean, because Treasury has also said the words that what will happen ultimately is that the Department of Environmental Affairs will audit what's going on. So let's just clarify, flowing from what Mansoor said. Two things are happening at the moment. Department of Environmental Affairs is working really hard and really quickly on refining the national greenhouse gas inventory. So that's the first point. The second point is the greenhouse...
Hang on, what is the national greenhouse inventory?
In a sense, what it says, it's a reflection of emissions, sources of emissions of greenhouse gases across the country.
Okay, so they're trying to find every single thing that is being used in any process which can emit a greenhouse gas.
Exactly. Whether it's going to be every single thing.
Are they then measuring those to see how badly they
correct?
affect?
Look, it's a report. It's a baselining exercise. Remember that you've got to understand all of this within the context of where South Africa places itself in the climate change negotiations and international climate policy. So we've made a voluntary statement that the country is going to reduce by certain percentages against business as usual by 2020 and 2025. Now, to be able to reduce, you've got to know what's there. Okay? And so the Department of Environmental Affairs is going through effectively the baselining exercise. And that is to devise the greenhouse gas inventory, and then, flowing from what Mansoor said, is to impose a reporting obligation upon companies that emit more than 100,000 tons of carbon dioxide equivalent annually, or that use power that results in the emission of more than 100,000 tons a year.
And just to elaborate a little bit further on that point, this is actually a tax on greenhouse gas emissions, not a tax on carbon dioxide, which is one of the greenhouse gases being emitted. But because it's quite cumbersome greenhouse gas emissions tax, carbon tax has become a proxy for all the other greenhouse gases.
Well, I was going
So if one has a facility that emits methane, for instance, that is a greenhouse gas, would be caught by the carbon tax.
Okay, I was going to ask that question because my only contact with, let's use the word carbon tax, is in that wonderfully green country, Zimbabwe, where as you drive in, you have to pay a carbon tax on your vehicle.
Yeah.
One of the things that I've heard in my circle of friends, and I can only relate to what their perceptions of it are, is the first thing that comes up is, oh yeah, here you go, another way that government can create another tax and capture more money from people already in the tax net, and they're just squeezing us again and again and again.
Good question, Mansoor. You answer that.
Yeah, no, that is a hospital pass.
No. It's just, I mean, because it comes up so often. We've discussed it quite a lot.
Okay.
I think if you look at the past 20 years, I would say the government has had a very good record in managing the fiscal base. Apart from capital gains tax in 2001, we haven't really had the introduction of too many additional new taxes. There's been rate changes that's occurred. With the exception of VAT, it went up from 11% to 14%. Most of the rates have been reduced downwards. Our personal income tax rates have been reduced progressively down with successive budgets. They've been at pains to emphasize that this carbon tax is not a revenue-raising measure. It's one that's meant to reduce greenhouse gas emissions. And in defense of that position, Treasury have said it would have been far easier if the intent was to raise revenue to simply push up corporate income tax, push up VAT, or push up personal income tax, rather than go through this whole process with several discussion papers, rounds of consultations to introduce a tax for the purpose of raising revenue. What it does indicate, I think, is a very interesting interplay between using a tax to achieve an environmental outcome and how well this fit will actually succeed. Because projections have been made about our carbon emissions footprint and how it will peak and plateau and then decline over the course of the next 20 or 30 years. And this tax is meant to change behavior. So because you'll be paying more for electricity, what it's meant to do is to encourage you to install a solar water geyser.
So this is actually more of a carrot and stick policy that is being introduced.
Precisely.
Or being looked at to be introduced.
Precisely. So we have some of the carrots being the solar water geyser program. Yeah. The stick would be the carbon tax to nudge us in that direction.
So let's talk about this, because you've got to understand the carbon tax within its broader context. So quite often you're seeing in the press a hysterical reaction to this. A big industry is going, perhaps we report to the Carbon Disclosure Project so we know what our annual emissions are, and effectively what seems to be doing is that people who are within those industries are considering the impact. They're just multiplying those emissions times 120 Rand, which is the initial effective rate of the tax. And they're going, this is going to put us out of business. The thing about that is that you've got to understand that there are a number of layers and nuances into the system. So in fact, the real rate of tax, as at its first impact, is only going to be between 48 Rand and 12 Rand per tonne. And that is as a result of the interplay of a number of allowances within the design. So one has to be very careful about reacting negatively to the tax without understanding...
Taking worst case scenario and just extrapolating.
Exactly, and I suspect people are doing that for effect. I mean, I can understand that. What is important, though, is the Treasury is absolutely determined that this is going to happen. We've been talking to Treasury for 3 or 4 years about it now, and we stay in very close contact with the tax policy unit. And the head of that unit, Cecil Morden, has been very clear. He said it's coming. It might be fractionally delayed depending on the design elements, but it's definitely coming. And the other point to note is that the full elaboration of the design is not necessary. That does not have to be achieved before it can be implemented, because the first period is what they're calling a so-called self-assessment period. Again, baselining, what do I have?
And it's also unusual because this tax is being split into 2 phases. The first phase will run from 2015 to 2019. So Treasury have already given a price signal for the first phase. They've given the rate. It will start at year 1. The published rate, 120 Rand per tonne of carbon dioxide equivalent, with 10% increments. So taxpayers can work out for the first 5 years what the carbon tax liability will be, provided they know what the emissions footprint is. And that will set the ceiling, which can then be reduced depending on the allowances that particular taxpayers would qualify for. So they could reduce the potential carbon tax liability by up to 90%.
But how do I work out what my carbon tax liability is?
You probably would not be liable for the carbon tax because you would not be in one of the emitting sectors.
How do I know when I am in an emitting sector?
A sectoral approach has been followed, listing particular sectors. So it would have electricity, coal mining, iron, steel and cement, and it would have a particular allowance for that sector. So companies would have to determine which sector they fall within in order to determine the ultimate carbon tax liability.
And
what there is this catch-all phrase at the end says other. So we have a whole list of specific sectors followed by a catch-all category marked other. So it creates a bit of confusion. When you're not in one of the specifics, are you in the other or are you not in the other?
But I will be affected though by the type of vehicle I buy.
Well, okay, so let's talk about a couple of things. First of all, this thing that is being called the carbon tax is not the first carbon tax that we've had in South Africa. We've had tax on fuels and tax on vehicles for some time. We've also had for some time what they call the renewable energy levy, which is currently 3.5 cents per kilowatt hour generated, imposed upon the generation of fossil fuel. The generation of electricity from fossil fuels. So Eskom collects that from us anyway. So this is not the first carbon tax. Second thing is that the carbon tax will be imposed in the manner that Mansoor has mentioned on so-called scope 1 emissions. So they are the direct emissions. The easiest thing to think about is Eskom. Eskom burns coal. Those emissions are scope 1 emissions, so Eskom will be impacted by the carbon tax. Now, how will you, Jeremy, be impacted? Because Eskom has been very clear.
They'll pass it on.
They will pass it on. It's one of the so-called legitimate pass-throughs that they can use, and they simply will do that. So, one has to understand that we are going to be impacted both directly, if I'm a big business, or indirectly, if I'm part of a supply chain or I'm a consumer. It's definitely going to happen. Why do we need to do this? Well, the reality is that as we go on into the future, the South African economy will become increasingly uncompetitive in the international arena if we continue to have a manufacturing baseline that is so heavily reliant on fossil fuel. And the carbon tax is one of a suite of mechanisms that government is implementing.
So it's like the rest of the world, it's like our trading partners implying, for want of a better terminology, a BB status on us.
It's called a border tax adjustment. It comes to us from the World Trade Organization law. Effectively, France is looking at this. France is looking at imposing a border tax adjustment, a tax on the import of goods to the tune of €20 a tonne relative to the volume of greenhouse gas emissions associated with the manufacture of that particular